Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Roger Holman and Neil Insull.
Welcome to The Tax Factor, the UK's top tax podcast. I'm Roger Holman.
Hi, and I'm Neil Insull.
Neil, it looks like our complaints about not being scheduled as presenters of the podcast were heeded by our top brass. And so, with what might be seen as undue haste, it's us again.
Not us again, but you could do worse. And maybe they just used up everyone else. So at least this podcast is free. Tariff free, I might add. So no 104% tariff on this podcast. Anything in the tax news this week that has caught your interest, apart from tariffs?
There's obviously our favourite topic on this podcast of national insurance. There's also a lot of tax changes coming or arrived.
A lot of tax changes.
Interestingly, there's a little Guernsey tax drop-in service that's been created.
Tell me more, Roger. Later.
And there's a few other stories that we may or may not get to. We'll see how our timing goes.
No, we'll get to them. We'll bore everyone. We'll rush through everything quickly.
So shall we start with national insurance, Neil?
Yeah, take it away, Roger.
Obviously, the biggest tax story of this week is the increase in the employer's rate of national insurance.
I thought you were going to say tariffs.
We're ignoring tariffs this week.
Oh, no, we're not talking tariffs. Sorry. Tell me about the other big increase in taxes.
So national insurance is payable only on salaries. So anyone who makes money from renting properties or dividends from investments doesn't pay national insurance. What's very strange about national insurance is it's both the employee and employer that actually pays it. What's happening here is back in October, our good friend Rachel Reeves decided that she wasn't going to renege on any of the Labour manifesto promises that they weren't going to increase taxes on working people and decided to increase taxes on working people's companies that employ them.
Good for her.
So national insurance has gone up.
Oh dear.
My question really is it about time that we really looked at merging national insurance with income tax? It seems a strange thing to just tax jobs rather than taxing other income at the same rate. What do you think, Neil?
I think you have a point, and it's been around for years. I mean, it's complication for the sake of complication. They're trying to put NIC take into a pot, which doesn't really exist. It all gets consumed by the same people. So, yeah, I'd like to see a change. I'd like to see simplification, and everyone understands where all this money goes, not to sort of classify it as a national insurance contribution, because long gone are the days since that actually happened exactly in that sense. So what do you think, Rog?
Yeah, I completely agree. I think national insurance as another tax is a very strange thing. It's always been very difficult for politicians to merge the idea of national insurance and income tax. Certain classes of people don't pay national insurance, including and especially the pensioners.
Well, I think it's a case of, well, let's wait and see, but perhaps not with any great hope we're going to see a change there. I think talking about NIC, of course, there were the increases in the rate of employers' NIC starting this month in April. We were mentioning at the top of the programme that there's a number of other changes. Some of them are more well known than others that are happening this month. Courtesy of the CIOT website, they've published a number of changes that we probably all should just mention in passing before we move on to the next topic. So apart from employers' NIC, a few other changes in tax. If you're Scottish, okay? If you're living in Scotland and you're paying Scottish income taxes...
You're not going to get me to do a Scottish accent, Neil.
I'm not, we'll try it later. But there's been a rise in their thresholds. We haven't got any rises in income tax thresholds in England, but we do in Scotland. So they're going to be £14 better off in cash terms. So good for them. The other thing that's changed is the SDLT nil rate threshold has now gone back to its normal level. So the previous level of 300,000 first-time buyers, 125,000 for other people. There's an increase in the interest rate on late payments of tax. So we're going to see a hefty rise in those interest rates. I won't go through them now, but be aware. So there's a new reporting requirement for company directors. So if you're a director of a close company, you need to report your dividend income receive from their company and the percentage shareholding of your company in your tax return for next year. Probably one of the more interesting ones, well, relatively, vehicle excise duty is increasing in this month. And most importantly, if you've got an electric car, electric vehicle, you're going to have to start paying for the first time. So you're going to pay £10 in your first year, but in subsequent years, that goes up to the normal rate, which I think is around about 195 every year. And if you've got a very expensive, well, not even very expensive, just an expensive electric car, so look out Tesla drivers, if there's anyone who's prepared to put their hand up to say they are a Tesla driver anymore, and that car's worth over 40,000, there's a luxury car tax, which is £425 a year. So all of this is brand new to people owning electric cars, and that starts this month. I think the other thing that just to mention is the demise of the furnished holiday lettings this month. Bad news for those who got furnished holiday lettings. There's an increase in the CGT rates this month for business asset disposal relief and investors relief, so those go up. That was all mentioned in the budget last year. There's the changes. We could go on for hours about the new changes for non-doms, but again, big changes, and some other smaller changes effectively dealing with agricultural property relief. So lots going on from April. A few things that are not changing. I mentioned it before, income tax thresholds in England not changing, which is a big, big deal. And that's called fiscal drag. And we've talked about it on other podcasts a lot. So let's move on, because that's some bad news.
That was a lot of changes all packed into a very short space of time.
Well, thank you. I'll take that as a compliment.
And I think, we love a list in tax, and it was a nice list.
Tell us about Guernsey, Roger, because I know you're desperate to move there. No, you're not, are you? Yeah. Are you desperate to move there?
Desperate to move on.
Oh.
Guernsey has released a tax drop-in service by its government. So if you're struggling in Guernsey to fill in your online tax return, your Guernsey tax return, that is, and yes, they do pay tax in Guernsey, then you can go to your local tax office and there will be people there who will help you to complete your tax return. What a novel thing. Actual people helping to complete a tax return.
This is an April Fool's joke.
It would be good if it were. I mean, I think it would be good, actually, if HMRC provided this service.
No, that would be a joke. That would
But even one day a year, it may help to actually get people filing their returns properly and filing them correctly as well.
Yeah, I think they should get these revenue officials standing on the end of streets, shouldn't they? Just to stand there, maybe with a desk and help people out when they need it.
Is that only when it's raining, though, Neil?
Any weather. But I like the idea. I like that.
Yeah, it's just a nice idea. I don't see it happening. I think our poorly staffed HMRC is probably stretched too thin as it is, but you never know. It might catch on.
So do Guernsey taxpayers pay in cheese and fish? Is that how they...
Milk.
Oh, yeah, Guernsey milk.
So, Neil, the other thing you've spotted in the news this week is a little tax case.
Oh, a cautionary tale of a man who's been stymied by the tax law. Now, how many times do we see that? A lot. This tax case is about a man who invested £3.5 million of his own money, Mr. Timothy Bunting, in a shop which was owned by his wife, a company, and the company sold old sports books and I can't even say the word. What is that word? Anyway.
Do you want to start again, Neil?
You can keep this in, actually, if you want. I'll start again. Memorabilia. Anyway, apparently, this was not a good shop. Okay, they didn't make any money, decided that there were no customers, and basically were going downhill very quickly indeed. So his £3.5 million was not going to get repaid, and he decided, well, the way to do this, to get tax relief on my investment in this company through this loan, is to convert my loan into share capital. So he ended up with shares being issued by the company to him. He didn't do it all. It was about over £2 million of shares were issued, and he then claimed claim, a negligible value claim in relation to the loss on those shares. And that actual claim failed because in order to get a negligible value loss claim, the shares have to actually fall in value. But the shares had no value when he acquired the shares. So he failed, and he goes, oh, damn. That was a bit silly. I'll tell you what I'll do is try and claim the other loss relief that he probably should have claimed in the first place, which was to do with the loss on the loan. So there is a piece of legislation which many of our listeners may well be aware of, which is if you loan an amount to a trading company, and there's various other conditions, you may be able to get loss relief for the amount that's irrecoverable. So he said, right, I've failed on my negligible value claim. I'll claim under this loss relief rule for the loan, which is obviously of no value anymore. The revenue challenged his claim because they said, no, the rules don't work like this, because what you ended up with was shares, not a loan that was outstanding that had become irrecoverable. And in the first tier tribunal, they were very, very sympathetic, obviously. And they said, well, the purpose of the rules is to allow people like you to get some loss relief for the value that you've lost. And he went away a happy man. Tim was happy. And then the revenue went back and said, well, no, we're going to appeal our case, and we're going to go back and actually argue that the loss relief rules do not work that way. And when you look at the loss relief rules, it's 253 of TCJ. You look at it and it says the loan has to be an outstanding loan becomes irrecoverable. And the revenue said, well, no, this was not an outstanding loan. It was a loan that had been converted into shares and therefore not outstanding, even though it became irrecoverable. And the revenue have won their appeal. So he loses completely. He loses completely on both sides of the coin. And if he'd only taken good tax advice, probably from you, Roger, actually, you would have given him the right advice. The day before he converted, he should have probably actually gone and made a claim for the loss relief, because he would have got his tax relief on that basis. So this is a sad tale of Tim, and not only did he lose $3.5 million, but he got no tax relief for it.
I think it's really a tale of Tim trying to be a bit too clever and trying to get income tax relief on the share loss rather than just settling for the capital gains tax relief.
I know. He was a little bit greedy, wasn't he? He wanted his cake and then eat it.
Well, sadly, HMRC don't like you to eat cake.
No. Anyway.
I think our last story this week is an idea about potentially maxing out your new ISA allowance.
Oh, because I've just maxed out.
Well,
actually, no, cut that, because that suggests I'm a rich man. But no. Right, go for it. Sorry.
It may be a good idea to max out your new ISA allowance now, given all the market turmoil. Now, of course, we can't actually give investment advice, so go and speak to your friendly IFA. But, with markets down 10, 11, 12%, some people might be thinking now's a good time to plough a bit of money that they've got sat around doing nothing into the stock market. It might also be useful to do the same with pension contributions. Have you got any comment there, Neil?
No, I think you're right, Roger. Now is the time to look at the market and decide what is the best approach. But as you say, Roger, we're not here to give investment advice. The other thing to mention, Roger, at this time, of course, is there's been a lot of press about whether we're going to end up with a cash ISA at the end of this year anyway. I mean, we've got cash ISAs this year, no cash ISAs potentially next year, or a very small amount. Let's see what happens. But anyway, it's something to discuss perhaps when we understand what Rachel's thinking might be in that direction.
I'm sure we'll have a budget special sometime in the autumn.
Happy days.
The Tax Factor from Blick Rothenberg.
Well, I think that's about all we've got time for in this episode of The Tax Factor. I see we made it into the top 100 tax planning podcasts of 2025.
What number's that, Roger?
Michael, what number was it?
Number 50?
It was number 50.
That's not right, is it? We'll have to do a naked version next. As usual, our website has a comprehensive collection of regularly updated insights and analysis from our team. You can find the links on our homepage, BlickRothenberg.com.
If you enjoyed this podcast, and I know I did.
I did too.
Try our sister podcast, Brave Business. We have a new episode available now, which takes a fascinating look at the topic of rapid scale-up businesses. Joining Declan Curry, our Blick Rothenberg partner, Stephanie Levin, and guests Aidan Rushby, founder and CEO of car finance business Carmula, and Mike Williams, co-founder of Jamaican patty manufacturer Flakebake.
And on next week's podcast, we have the Queen of Tax herself, Heather Self.
Whatever.
And joining her, Rahana Earl.
But from me, it's goodbye.
And from me, it's goodbye.
That's the Tax Factor. If you enjoyed the Tax Factor, please like, share, and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.